Welcome to this month's edition of Up to Speed, Baker Tilly's automotive industry podcast. I am your host, Mike.mader, the dealership industry leader for Baker Tilly. On a monthly basis, Up to Speed serves as the automotive industry's connecting point to hear about conversations from industry leaders regarding topics that pertain to the tax, accounting, and operations side of your retail dealership. We are in your mailbox the third Wednesday of every month. And if you'd like to listen to some of our past episodes, you can find them at www.bakertilly.com/dealerships. Also, if you have a topic in mind that you would like some further discussion on or some insight on, please feel free to let us know by reaching out to our website. Our goal is to provide you with relevant, up-to-date information that is quick and easy to digest that you can watch or listen to on the go. In our July episode of Up to Speed, we discuss some of the legal pitfalls that you can encounter in the merger and acquisition market and what you should be aware of. In this month's episode, we are going to keep up with the merger and acquisition theme and discuss some alternatives to raising capital that you can use to acquire your next dealership or expand your operations. With me today is Dan Garces of Capital Automotive. Welcome, Dan. Glad to have you on today's episode.
Hey, thanks, Mike. I appreciate it. And also, I want to say thanks to Baker Tilly. Sponsoring these kind of information series for your clients is just a terrific value add to them. So I'm really happy that we can be a part of it. And thanks for inviting us.
Perfect. Thanks, Dan. So Capital Automotive is the first company solely focused on providing highly tailored sales leaseback capital to the automotive retail industry. And they've been supporting dealers for over 26 years. They manage a portfolio of dealership real estate valued at over $4.5 billion in the United States and in Canada. Capital Automotive has assisted public and private dealer groups in growing their organizations, acquiring new locations, upgrading existing facilities, constructing new stores, and facilitating estate planning and partner buyouts. So Dan has been with Cars for 22 years, serving in various roles, and is now their president and chief operating officer. Dan, I've known you for quite a long time. So why don't you share with our audience a little bit more about your background?
Sure, absolutely. Thanks. My background really, I started my career in commercial banking. So I was a lender for almost 10 years. And in one of those banks I was at, Comerica Bank, I was lending to car dealerships. I was a floor plan lender doing real estate loans, cap loans, acquisition loans for dealers, all over the Midwest at that time. So that's really how I got into the car business and supporting and financing the automotive industry. After working at Comerica, I did join Cars about 22 years ago, as you said, and ever since then, I've been supporting dealers through our sale leaseback product.
Oh, that's awesome, Dan. Well, thank you for your insight, and we'll get into it right now. So the title of our episode is the real estate side of the dealership merger and acquisition. So you're a real estate company. So how is Capital Automotive involved in the merger and acquisition process? Because a lot of times we don't think of the real estate as much as we do the operations. Most of the focus is on the operations side. So give us some insight there, Dan.
Yeah, so that's a good question. Most of our investment activity actually comes from the buy-sell market. We're really a financing source for the buyer. So just like a bank or an equity partner, we bring capital to the closing table. The difference is that we bring more capital than a bank, and our cost of capital is less than an equity partner or even less than your own equity. So we really can help the dealer underwrite the real estate side of the acquisition while they focus on operations. Mike, you'd mentioned, underwriting operations takes a lot of work, and it's true. I mean, the dealers, they hire professionals like Baker Tilly to perform a quality of earnings study or to guide the dealer through, tax strategy or entity formation. There's a whole host of items that you guys support in underwriting the operations. The dealer has to understand the franchise they're buying, the markets they're in, whether there's operating efficiencies from the selling dealer that they can continue, or are there improvements that they think that they can add to the operating efficiency of that dealership? So, that's a lot of diligence and underwriting just on the operations side. And as you know, that's really half the acquisition, because real estate values today, they're generally either equal to or sometimes even more than the blue sky value on a buy sell. So, we're not just efficient capital that's less expensive than your own equity, but we bring a team of professionals that help you coordinate and underwrite the real estate side of the acquisition.
Okay, and I think we're going to get into some of the unique things on the real estate side, because like I mentioned earlier, I think we take for granted real estate's real estate. And all we need to do on the real estate is get the real estate purchase agreement put together, get the financing from the bank, and we're all set. But I think we're going to probably dive into a few more things that you're going to give us some insight on as far as how that affects the acquisition or the potential acquisition. So what do you see as some of the biggest issues that you're seeing on the real estate side of a merger and acquisition transaction today?
Yeah, that's fair. And like you said, I mean, a lot of people do take for granted, oh, we're just buying the business, but the real estate's just an add-on to it. And really, there are several issues from valuation, financing, and coordinating all the diligence in an acquisition. And if you're buying multiple properties in a dealer group, that expands by 3 times, 4 times if there's 5 properties or 6 properties in the acquisition. So let's just start with valuation because that's kind of the biggest one that really people start to focus on first. Often in a buy sell, the biggest question is, what is the property worth? And usually you get an assessment evaluation in a buy sell. The reason you get an assessment or an appraisal is not because that's the number you're going to end up buying it at. You have to use it as a guide to, for the seller and the buyer to agree on a fair price of the property. The appraisal may say it's $10 million, but if the seller is telling you, I'm not going to sell for anything less than 11, then you have to decide, how you're going to proceed. Same on the opposite side. If the buyer says, I'm not going to pay more than 9 because I don't think the store can afford rent at a higher rent factor, then the seller and the buyer have to agree on a price. So don't think that the appraisal is the Bible. It's really just a way to start your negotiation and your discussion on what a fair price is.
But we often see that in the deals where the appraisal is the number. On a number of deals that we've just had,
Mhm.
it's like, hey, you know what? We're going to be willing to pay this much, but we're going to pay what the appraisal comes out at, and that ends
Yeah,
up being the ending number. And then it gets down to the closing table after that appraisal gets there, and it's a dispute. Like, hey, the appraisal came in at this. This is what, yeah, but we can't afford it. So,
yeah, that's right. And you can see there's really 2 ways to do it in an APA. We've seen it both ways. You have a fixed price in the contract, but even that is still going to be subject to an appraisal at some point because remember the buyer has to finance the property typically, and so they're going to
right.
go to their lender. They're going to get an appraisal at that point, and they may need to have an out that says, hey, we can't afford to finance this property because the appraisal came in way lower or the buyer has to put in more equity into the transaction. But more commonly, like you said, is it's based on future appraisals. So you typically see like a 3 appraiser method or something like that as a way a buy sell gets to move forward to get to the valuation phase. And when you're doing the 3 appraiser method, it's really that's a totally acceptable way to do it. But you need to make sure that both parties agree on the type of appraisal that is being ordered. Is it fee simple, leased fee? And what the appraiser is really looking at when they're underwriting their valuation.
Okay.
So yeah, types of appraisals can vary, greatly. Sometimes people get appraisals for just insurable value, or if you're contesting real estate taxes, or if you're doing estate planning, and those are totally different reasons and valuations that you might come up with than if you're in a buy sell or if your lender is looking to mortgage the property. So, there are different ways you can approach valuation. There are 2 really big differences. One is people can get a broker's opinion of value. Now, a broker's opinion of value is what it sounds like. It's an opinion. It's done by a local person in the marketplace, a broker who looks at comps in the area of properties that may have just sold recently and says, hey, we think that if we were to take this property to market today, this is probably the price we could sell it for. There's not as scientific of an approach in a broker's opinion of value. A lender's not going to lend against a BOV. So don't rely on a BOV for an acquisition or a buy sell because that is definitely something that a lender is not going to rely on as well. So the second type is just getting a full appraisal. And there's Uniform Standard Professional Appraisal Practice, or USPAP, is like a standard that appraisers have to follow when they're doing valuation. And that's what a lender is going to accept. That's what a buyer and a seller should really agree on with their price.
Okay. So valuation is a big part of it, but there's got to be more issues or big issues that are in the real estate side as well.
Yeah, I mean, look, valuation is very important, but there are also financing challenges. interest rates are changing, loan to value that the banks are lending has changed. Even the bank's general appetite for real estate debt has changed over the last few years. We've seen interest rates going up. Gone are the days of 4% mortgages right now. LTVs have decreased. Lenders used to be as aggressive as 85% and sometimes even more on an LTV. We're seeing that change now to 75% or even 70% because the banks, there are regulations that have increased their capital requirements. And so the banks have to either lower leverage or increase their interest rate to make up for those capital requirement changes. Definitely banks are tightening on what they're lending in real estate. Also, most banks, they'll won't do a real estate loan with a dealership property without having the floor plan relationship as well. Banks who provide floor plan are, also supporting real estate, but they need to have that other bank product within, their relationship with the borrower. So that's really important. If you're just
they've got that hard brick and mortar collateral.
That's right. They have the hard brick and mortar, but they also have the banking relationship with other products because they're more focused on the deposit accounts, the floor plan relationship, the other types of banking products that they can offer to support the dealer in that case, and the real estate is just something they kind of do because they have to, and so they're not as excited about the real estate side of the equation.
Okay. Any other issues that you're seeing, bigger issues in the M&A world?
I think another big thing that happens with M&A is just coordinating and interpreting all the diligence reports that come in. So, when you're buying a store, the buying dealer, their diligence team, whoever it is, they need to understand what's under the real estate, what's on the real estate, and things that are just like not even visible on the real estate, like zoning or use permits and restrictions and on title and things like that. So, you really need to have a good understanding of all of these other components of the asset that you're buying. And that's where we can help too, because we have a lot of experience in doing that, and we can coordinate, all of those due diligence items, read them, interpret them, and kind of report back to the dealer, what we're seeing and what we're finding within that real estate investment. So I'm going to break it down just on a few of those pieces. I mentioned under the real estate, that the most obvious there is environmental. Have oil water separators been regularly maintained, or how old are they? What type of lifts are being used on the property? Are there clear maintenance records of those lifts? Underground storage tanks, less common today on properties, but if there were underground storage tanks on the property and they were removed, were there clear records of how they were removed? And sometimes even the neighbors of a property impact the environmental risk on a property. So does the business next door provide or pose an environmental risk to you? These are things that you really need to understand as you're buying a piece of property, and they really are important for the buyer. Now, the seller should have good records, and even if you're not selling, by the way, if you're just refinancing your property and you're going to own it for another generation in your family, you're going to have to refinance that property on a regular basis. So you're going to get updated environmental reports, phase ones. And if you have great records, if you show regular maintenance of your oil water separator, or you show that you shut down an old in-ground lift properly, and you can demonstrate that to the phase one or to the environmental engineer that's doing the phase one, that can save or maybe even eliminate the need of a phase two. So these are really important things to do just as you're operating your business, keeping good records of environmental risk on the property.
Okay.
On the real estate now, I'm talking, instead of under, but actually the buildings, the structure, reporting immediate needs of the property condition. We will generally get a property condition assessment. This is oftentimes done by the same environmental engineers or same firm that did the environmental report. They'll also do a property condition assessment, and you can think of that as like similar to a home inspection on your home if you were buying a new home. A property condition assessment looks at all the maintenance items on the building, like HVAC or the roof. Are there remaining warranties on the roof, or has the HVAC been maintained properly? Are there required capital improvements in the next few years of this property? You know, does the parking lot maintenance look appropriate? Is there pooling on the property? These are things that the environmental or the PCA and engineer is going to be looking for when they go through a property. And this is also, again, really important, not just in a buy sell, but on properties you own, because when you're refinancing them, these are things that are important that you want to be able to demonstrate that you've been maintaining the property correctly.
So I want to dive into that just a little bit.
Sure.
When we're going through a merger and acquisition or a buy sell transaction, the manufacturer obviously gets involved, and not often, but sometimes they exercise their ROFR, the right of first refusal. So when the facility, in most transactions you see, the attorneys try to tie in the facility with the sale of the operation, because it's less that the manufacturer wants to exercise the ROFR because of that. But is there a situation that if a buy sell occurs, and let's say the dealership was re-imaged 5 years ago, so it's up to the image standards, but yet a certain portion of that, let's just say the flooring, the tile flooring, tile flooring isn't adequate to what the manufacturer put in their re-imaging standard, can the manufacturer stop that transaction from happening, or require that buyer to update that flooring as soon as they come in, or up whatever aspect of the building is, assuming it had already been approved by the manufacturer for the reimage, but there was a bad quality installation done of some product of the facility?
Well, if there's bad quality, I mean, I don't think the manufacturer can actually, require that, but certainly the buyer might want that to be repaired or fixed to be a good quality. But as far as the manufacturer requiring, updates to their facility image, the selling dealer is protected for a period of time, depending on the state and the local ordinances. But they are protected for a period of time, that they do not have to do that or upgrade a facility. Now, the manufacturer definitely puts a lot of pressure on a buyer, and they will, influence the buyer and saying, we don't know if we can approve you unless you agree to these certain things. And it is definitely an issue that we see very regularly, where the manufacturers are putting, significant pressure on a buyer to upgrade a facility. But if it's, something minor like tile or something like that, I don't see that really stopping a deal, and the manufacturer probably can be a little bit more patient with something like that. But if you're talking about a full image, but if you're talking about a full image upgrade, absolutely, they will put pressure on dealers that are, 2 generations behind in an image upgrade, for example.
Okay, so maybe the manufacturer can't force them to fix the tile, but obviously it's going to have an effect on either the blue sky or the price of the real estate, one or the other.
Absolutely.
Okay, all right. So we've heard a lot about private equity investing in dealership space. Are you seeing quite a bit of that as well?
Oh yeah, absolutely. I mean, PE, and large family offices, not just private equity firms, they operate similar to traditional PE. They're definitely continuing to invest in the auto retail sector. I mean, of the top 150 dealers that report under Automotive News, I mean, there's just a large number, and it's a growing number of dealer groups that have some kind of PE or family office, equity investment, in their dealership groups. It's funny, even cars. I mean, we're supported by a form of private equity. The equity sponsor behind our company is Ares Capital Management. So, Ares is a global investor that manages over $350 billion of assets all over the world. So, they're a form of private equity investment in our space. And I think the interesting thing about private equity is, sometimes people react to that term, but it really is a positive trend to the industry, and it should keep values high in, blue sky values for dealerships. The PE investors aren't something to be afraid of, really. Depending on who your partner is, they can actually bring a lot of value to the table, to the operations. I think one thing that we need to think through is that there are different kinds of equity investors. So, if a dealer is considering private equity, they need to explore those kinds of investors. I mean, Mike, I mean, there are some that are seeking like a minority investment in dealer groups, and then they will want to invest in a group that has strong operating structure, and they're really not going to get involved in the day-to-day decisions at the operations. There are others that are seeking majority control, so they are going to be more involved in decisions at the operating level. There's a balance between that too. There are some that will take less of a role and more of a role, and so your clients should do their diligence when they're working with you at Baker Tilly to explore those options, because they could significantly accelerate the growth potential of a dealer group. And it's not something to be afraid of. Private equity, I think, is a positive investment in this space, and it's going to help keep buy-sell activity moving forward.
Yeah, so similar to cars, Baker Tilly also has a private equity partner.
That's right.
And I think it's going to be a very positive outcome for our firm as well. So when dealing with the private equity, are they also buying the real estate along with the operations?
Private equity investors have some different interests in kind of the return on investment. And so a lot of times a PE firm is less interested in the real estate because, frankly, the returns on real estate are lower than they are on operations.
Right.
So if the private equity or any investor has limited capital, they're going to think about where they're going to put their capital to get the best return, and that's in operations. It's not generally in the real estate. Real estate's a great investment, obviously. I mean, we do it, and we like real estate a lot, but it is a slower growth investment, and it doesn't generate the same type of return as buying, 3 more dealership operations would. So PE investors do look at, the operations a little bit more, favorably than investing in the real estate.
Okay, so with that being said, I mean, most dealers, when they sell their operations, they sell the real estate along with it.
Yeah.
Are there situations where it may make sense for the dealer to hold on to the real estate and only sell the operations?
Yeah, that's a good question. I would say no. I don't think it's a good idea for the selling dealer to individually retain the real estate. If they're selling the operations, they should sell the real estate, either to a third party or to the buying dealer, but they should definitely sell the real estate. It sounds like a good idea at first. I mean, you've owned the real estate, let's say, for generations, and now you're selling the store and you think, well, I can just collect the rent. It's a passive income. I mean, it is a good idea. And my answer may sound a little counterintuitive because, coming from me, that's what our company does. We buy real estate, right? But we are a professionally managed portfolio company. We're set up to deal with the nuances of ownership of real estate. That includes funding construction projects in the future, or processing lease assignments from one dealer to another. So if a dealership sells, we have to underwrite who the new tenant is going to be and allow that assignment to happen. That's something we're set up to do. We handle easement requests all the time. We're dealing with signed consent forms. We're constantly refinancing the portfolio. So as debt matures, there's a lot of management of the real estate. It's not as passive as you might think. And with the dynamic industry in the automotive space, dealerships move franchises. We have to be responsive to that, and it's harder if you're an individual investor.
Okay.
I want to go in a little deeper on this too, because I think this is a little bit important to talk about. I mean, if you're an individual and you no longer own the operations on the property, there's a lot of other things to consider. I mean, lenders take a totally different approach on financing investment property, just to be clear. They typically won't offer, an LTV that you would get if you were the operator on the property. I mean, it could be as low as 50% LTV if you no longer control the operations on the property. So, you may have a good mortgage in place right now, you sell the dealership, but when you come to refinance that, the lender's going to take a totally different approach. You're taking 100% of the refinance risk too. In the future. I mean, you're going to need to get a new appraisal on the property. You're going to get an environmental report on the property every 5 to 7 years, because typically real estate loans are 5 to 7 years in duration. So at some point, you're taking all that interest rate risk. You can't pass that along to your tenant because they have a fixed rent factor. So if interest rates rise, you're going to start carrying it at a higher interest cost for yourself.
Yeah, it seems like a lot more risk involved in holding on to that real estate than it is. And if you're retiring from the operation, you're pretty much retiring from everything it should be.
That's right. And we've seen people hold on to it, and eventually they want to liquidate their investment, right? So they've held on to it for 3 or 5 years, and they're like, okay, now I have a use for the fund. Sometimes they hold on to it because they don't know what they're going to do with all the cash, right?
Right.
So when you get to that point of liquidating the investment, the value is going to be different because now you have a long-term lease agreement on the property. And so the valuation is subject to that lease. If there's less term on the lease or if there's, terms that aren't considered market terms within your lease, that could negatively impact the valuation of the property. If the lease terms aren't market, you could, or if there's, 5 years left on the property or on the lease, you could be you could suffer a downgrade in the valuation of your property just for that reason.
Yeah. Okay. So best advice is probably sell it all when you're going to sell.
That's right.
All right. Well, Dan, I very much appreciate you taking time today to giving us some insights on the things that relate to the real estate side of a merger and acquisition transaction. So appreciate it. Thank you. I look forward to working with you in the future again. So
well, this was great, and thanks for inviting us here to share some information with you and your clients. I hope they found it informative. If anybody has any questions, they can certainly reach out to their representative at Baker Tilly or directly to us, and we'd be happy to talk a little bit more about your real estate questions.
Okay, thank you. So that concludes this month's episode of Up to Speed. To our audience, thank you for joining us today. And if you have any questions for Dan or would like to discuss the opportunity of raising capital for your next acquisition, his contact information will display on the screen at the end. And feel free to reach out to him directly. So we look forward to seeing you in our next Up to Speed episode. And remember, we arrive in your mailbox the third Wednesday of every month. And you can also visit our website at www.bakertilly.com/dealerships to view past episodes of Up to Speed. Until next month, make it a great day.